Welcome to another deep dive. Today we'll be taking a look at 7 secrets to investing like Warren Buffett.
Oh, okay.
Co-authored by Mary Buffett and Seah.
Right.
Now, Mary Buffett, she's Warren Buffett's ex-daughter-in-law, and Seah is a prominent investor who attributes his financial success to Mary Buffett's earlier books on Warren Buffett. So fascinating, right? To help us navigate through this book, we have an expert with us.
Happy to be here.
So this book really seems to be a fantastic roadmap for those who are just beginning their investment journey.
Absolutely. And I think, it doesn't overwhelm you with like a ton of complicated jargon. It really focuses on those foundational, financial habits, getting those solid first.
Okay, so let's dive into those habits.
Sure.
So the book starts out with the concept of paying yourself first, which is, classic Warren Buffett.
It is.
What's your perspective on that?
I think it's about making a mindset shift with money. Instead of the sort of common, spend first and whatever's left over, you save.
Right.
He says, set that money aside first before you do anything else. And then whatever's left over, that's what you spend on your needs.
I see that as like, pre-commitment strategy. You're telling yourself this amount is off limits. This is dedicated towards my future self.
It is. And he reinforces that with a really powerful story in the book about him picking up a penny.
Oh.
Which may seem a little, strange.
Okay.
But it highlights his belief that, every cent counts.
Right.
In building wealth. And it's not about being cheap. It's about valuing the smallest amount of money.
Take care of the pennies and the pounds will take care of themselves.
Exactly.
I like that.
And he offers a really practical tool in the book. He calls it the savings game. And you start small.
Okay.
Saving a little bit each week, and you increase that amount every week.
So it's like a challenge you can win at.
Exactly.
I love the the game, like the challenge.
Right.
So now building wealth, it's not just about saving. It's also about finding a job that you're passionate about. And the book kind of delves into that a little bit.
He does.
Yeah.
He says, he has a really bold way of putting it. He says, taking jobs to build your resume is like saving up sex for old age.
Okay.
Basically saying you spend a huge amount of time at work.
A lot of your life.
A lot of your life. Don't spend it doing something you hate.
I appreciate how he's really straight to the point.
Absolutely.
No sugarcoating whatsoever.
Absolutely.
It's about prioritizing your passion and the fulfillment in your career and not just chasing, a prestigious title or a big salary. And he offers a tool to actually figure out what your passion is.
He does. It's called the passion test.
Okay.
It's a 4-quadrant exercise to help you identify what you're really good at, what you love, and what makes you mad. So you take those things and you try to find a career that's aligned with all of those.
So it's like a compass.
Yes.
Pointing you to the direction you should be going towards.
Absolutely.
Very interesting. So, we've talked about passion, but let's talk about risk management. The book also dives into that a little bit.
He does.
And this might not be the most interesting topic.
It may not be the most glamorous.
It may not be the most glamorous, but it's a very critical one.
It is. And he highlights this by sharing a statistic, which is that 63% of Americans can't cover a $500 emergency.
Wow. So why is it so crucial then to have this safety net in place?
Well, because, life happens. We all know this. Unexpected expenses come up.
Right.
And so he lays out 3 key principles of an emergency fund.
Okay.
So number 1 is it's not for investing.
Okay.
You don't touch this money for anything other than an emergency.
So this is completely separate.
Completely separate. Number 2, it has to be easy to get to. So you don't want it locked away in some, long-term investment.
Yeah.
And number 3, it has to be out of sight, out of mind.
I see.
You don't want to be tempted to use it.
It's like that fire extinguisher.
Exactly.
You hope you never have to use it.
Absolutely.
But you're glad it's there.
Absolutely.
And he also talked about insurance, right?
He does.
Which also plays a role in risk management.
Absolutely. Absolutely. He talks about medical, disability, life insurance, all those things that can help you manage those big risks.
So it's about preparing yourself for those risks that you might face and taking the steps to mitigate the impact of them. Now, once we have all these things in place, let's talk about investing like Warren Buffett, which fundamentally is about
It's about owning a piece of a business.
Okay.
That's the core concept.
Yeah.
When you invest in stocks, you're not buying, some numbers on a screen. You're buying a stake in a company.
Right.
You're becoming an owner.
I think it's really helpful to visualize it that way. For example, when you're buying shares of Coca-Cola, you're buying into a company that sells, what, billions of servings every day around the planet, right?
Exactly.
Every can, every bottle sold that contributes in a very small way to your overall return.
Absolutely.
So it's about participating in the success of a business that you believe in.
And it humanizes it, You're not just betting on tickers, you're betting on real companies and real products.
Right. But it's not as easy as buying any stock that catches your eye.
Absolutely not.
There's a method to it.
There is.
Right. It's not about chasing trends. It's about making those calculated decisions.
It's about value investing. And that means not just finding a good business, but buying it at a good price.
Right. So finding those diamonds in the rough.
Yeah.
Finding those hidden gems.
Exactly.
The undervalued ones. But the stock market's like this big jungle, right?
Right.
It can be really overwhelming.
It can be.
But how do we navigate it?
Well, the book has some really interesting ideas for that. One of them I love is it's about focusing on your circle of competence.
Okay.
Which basically means investing in the businesses that you understand.
Okay.
For example, Warren Buffett, he famously avoided tech stocks for years because he didn't really get them.
Right. And so you're leveraging your existing knowledge.
Right.
Your experience.
Absolutely. It's about sticking to what you know.
But how do we go about finding those undervalued businesses within our circle of competence?
Well, they actually offer another really interesting idea called the shopping mall strategy.
Okay.
Which is basically Warren Buffett gets a lot of his investment ideas just from being a consumer,
Right.
From going out and seeing what people are buying, what brands are popular. So he's looking around, he's noticing what's successful.
So the understanding customer behavior.
Exactly.
Figuring out what people are buying.
Right.
And applying that.
And using those insights to make investment decisions.
I love that. So he says to follow the rich, right?
He does. He suggests looking at the lists of, like the Forbes list of wealthiest people.
Right.
Because a lot of those people made their money through companies that are publicly traded.
So if you like the story of Bill Gates and you think Microsoft is a good company, you can invest in that company.
Right. Okay.
It's about, maybe those people know something.
Oh.
That we don't, and we can use that information.
All right, so we've identified some promising companies. How do we go about evaluating them, determining whether they truly are, companies we want to invest in?
Well, one of the key things to look for is what they call an economic moat, which is essentially a durable competitive advantage.
Okay.
Something that protects that business from its rivals.
Like what? Can you give me some concrete examples? Sure, they break it down into a few different types. Number one is branding. Think about Coca-Cola or Nike or Apple. They have such strong brand recognition, people are willing to pay extra for those products.
Yeah, I find myself going to those familiar brands sometimes.
Right.
Because they're established, there's a trust factor, there's a quality associated with them, maybe.
And then you have, something like product differentiation. So a company like Tesla, they make a really unique product, and they appeal to a certain customer that wants that unique product. Then you have economies of scale.
Okay.
So a company like Amazon, because of their size and then their network,
right,
they can buy things cheaper. So they have an advantage over their competitors. Yeah. And then you have high switching costs. Think about a company like Microsoft Office.
Okay.
It's so ingrained, to switch over, it would be really, really difficult and expensive.
It's like you're locked into that.
You are. Even if something else is better, you don't want to switch because it's too hard.
Okay.
And then finally, you have legal barriers to entry.
Okay.
So, something like patents in the pharmaceutical industry.
Right. So they have exclusive rights to produce certain drugs.
Absolutely. And they can charge, whatever they want because no one else can make it.
So we have branding, we have product differentiation, economies of scale, high switching costs, legal barriers to entry. So it's like a checklist.
It is. And it's important to remember that these moats, they can change, for example, think about e-commerce and what it did to retail.
Right.
The old retail giants, they had huge economies of scale, but then everyone started shopping online.
Right.
And it completely changed the game.
So being vigilant and adapting to the changing landscape.
Absolutely. And some companies have multiple moats.
Okay.
So, they might have a great brand and a great product.
Oh, so that it's better, right?
Absolutely. Absolutely. It makes them even more defensible.
And it all comes down to understanding, the business, the industry, and the long-term prospects. So we need to be able to understand the language of business, which means we have to understand those financial statements, which can be very intimidating.
They can be, but the book does a really nice job of simplifying those concepts and making them accessible.
Okay, before we dive into that, why are those reports so important?
Well, they tell you the story of the business. They tell you how it works, how it makes money, how it manages its finances.
Okay.
It's like looking under the hood,
Okay.
so you can see what's really going on.
So it's not just about the stock price or the fancy marketing.
Right.
It's about truly understanding the financials behind the business.
Absolutely.
All right, so let's start with the balance sheet.
Sure.
What's the key takeaway there? What are we looking for?
Basically, the balance sheet, it shows you what a business owns, which are its assets.
Okay.
What it owes, which are its liabilities. And what's left over for the owners, which is the equity. It's a snapshot of the company's finances.
Can you give me like a simple analogy?
Sure. Imagine you're looking at your own personal balance sheet.
Yep.
Your assets would be your house, your car, your savings, your investments.
Okay.
Your liabilities would be things like your mortgage, any loans you have, any credit card debt.
Right.
And your equity would be the difference between those two. So it's the value of what you own minus what you owe.
And we're applying the same logic here to a business.
Exactly.
But how does this translate into an investment decision?
Well, there's a couple key questions to ask. Is the equity growing?
Right.
Is the business becoming more valuable? And how much debt does the company have?
So we're looking for businesses that are increasing in value.
Absolutely.
Managing their debt responsibly.
Right.
What about the income statement?
So the income statement, it's like the business's report card. It tells you how much money they made, how much they spent, and what their profit was.
So it's like revenues, expenses, and profits.
Exactly. And you want to see, is the business consistently profitable?
Right. So consistency is key.
Consistency is key. And then you want to look at something called return on equity.
Okay.
Which basically tells you for every dollar that the shareholders have invested,
right,
how much profit is the company making?
It's a measure of how effectively they're utilizing those resources to generate those profits.
Exactly.
All right, so we have the balance sheet and the income statement.
Right.
And the last one is the cash flow statement.
The cash flow statement.
Why is this so important?
Well, it tracks the actual cash that's coming in and out of a business.
Okay.
It goes beyond those accounting entries and looks at the actual movement of the money. So is the company actually generating cash?
Right.
Or are they, relying on debt?
So it's the difference between profit on paper versus the actual cash in hand. Why is this distinction so important?
Well, a company could be profitable on paper, but have a lot of unpaid bills. Or maybe they've made sales, but haven't collected the money yet.
Oh.
So there's a difference between what the accounts say and what's actually in the bank account.
So what should we be looking at when we're analyzing the cash flow statement?
Well, first of all, you want to see if they have positive cash flow from their core operations.
Right.
So are they making money from their actual business?
Yeah.
And then, what are they doing with that cash? Are they reinvesting it back into the business? Are they paying dividends? Are they paying down debt?
So it's like we're seeing how they're allocating those resources.
Right. We're looking at their financial decision making.
Okay, so we've talked about the balance sheet,
Absolutely.
the income statement, and the cash flow statement. Do you feel a little more confident in navigating those statements now?
I certainly do. I'm starting to see how those numbers tell a story. But understanding the language is just one part, right? We need to know how to actually value a business.
Absolutely.
Make the right decision.
That's where the art and science of valuation comes in.
Okay, so how do we do that?
Thankfully, the book gives us a few different tools that we can use.
Oh, a toolkit. I like that.
A toolkit.
Yeah.
And each tool has its strengths and weaknesses.
Okay.
So we have to figure out which one to use in which situation.
Right. Let's explore.
Okay, let's start with one of the more conservative methods.
Okay.
Which is Benjamin Graham's net-net technique.
Net-net. So that seems very focused on accounting.
It is.
What's the logic behind it?
Basically, the idea is to calculate how much money you would get if the company just sold everything and paid off all its debts.
Okay.
So what's the breakup value of this company?
Like, what's the intrinsic value?
Right. Based on the hard assets.
Exactly.
Like, we're assuming everything else is worth zero.
Right. The brand, the customer relationships, the future earnings, all of that is zero.
And then
we look for companies that are trading at a big discount to that.
So we're trying to buy Buy $1 for 50 cents.
Basically.
Wow.
It's a very safety-conscious approach.
Okay, but how do we actually calculate this?
Well, we start with the balance sheet.
Okay.
We look at their current assets and their total liabilities,
Okay.
subtract the liabilities from the assets,
Right.
and that gives us the net current asset value, or NCAV.
Okay.
Then we divide that by the number of shares outstanding, and that gives us the net value per share.
Okay, and so according to Graham, we want to be buying stocks at 2/3 of that value or less.
Absolutely, because that gives you a margin of safety. Even if your calculations are a little bit off, you're still getting a good deal.
Right.
But, even with that margin of safety, you still have to be careful because a company could keep losing money.
Right.
And even if it's, undervalued on paper, it might not actually be a good investment.
So we have to look at the business as a whole and not just the numbers.
Absolutely.
Okay. So that's the net approach. What about price to book value?
Price to book value, or PB.
I've heard that term before. So we're comparing the market price to its book value. But what is book value?
So book value is basically the company's net worth.
Okay.
As it's reported on the balance sheet. You take their assets, you subtract their liabilities, and that gives you the book value.
So it's similar to the net, but we're looking at all the assets, not just the current assets.
Right. We're looking at all the assets, so things like property, plant, equipment, any investments they have.
Why is that important?
Well, for some businesses, those assets are really important. Think about a manufacturing company, their factories, their equipment, that's where a lot of their value is.
Okay, so we're not undervaluing a company just because its current assets are low.
Exactly.
Okay. So how do we use this price to book to inform our decisions?
Well, we divide the market price by the book value, and if that number is less than 1,
Okay.
that might suggest that the stock is undervalued.
So if the market price is lower than its net worth per share,
Exactly.
so we're getting a good deal. But does that apply to all kinds of businesses?
That's a great question. The book cautions against using it for businesses where intangible assets are really important. So think about a tech company.
Okay.
Their brand, their intellectual property, that stuff's not really reflected on the balance sheet.
So this is more for those asset-heavy businesses.
Absolutely. Like banks, manufacturers, real estate companies.
Where those assets are a big part of their value.
Right.
Okay. So we've looked at the net, the price to book. What about the price to earnings, or the PE ratio?
The PE ratio, the classic valuation metric.
I hear this thrown around all the time. So we're looking at the company's stock price compared to its earnings, right? So how do we calculate this ratio, and what does it actually tell us?
Well, you take the current market price, you divide it by the earnings per share over the past 12 months,
Right.
and that tells you how much investors are willing to pay for each dollar of earnings.
But how do we interpret that number? What's considered a high PE or a low PE?
Well, that's where context is important.
Okay.
The book has a table that shows average PE ratios for different industries.
Right.
It also suggests looking at the company's historical PE ratio and seeing how it compares to the current one.
So it's about understanding the benchmark, both within the company's history and within its industry.
Exactly.
To figure out if the PE ratio is actually attractive or not.
And of course, growth potential is a big part of this.
Oh.
A company that's growing really fast might have a higher PE ratio than a company that's not growing at all.
So we're paying a higher price for the expectation of future growth.
Exactly.
Interesting. So we've covered net, price to book, the PE ratio. Those are 3 tools.
Mm-hmm.
Are there any others?
Yes. The book also introduces the dividend yield, which measures the return you get from dividends.
Yeah, dividends, those are the payments made to shareholders from the company's profits.
It's a way for companies to share their profits with their owners.
So it's like a regular check from the company.
A little paycheck from your investment.
But those are not guaranteed.
Absolutely not.
Companies can reduce them or eliminate them.
Absolutely. That's why you want to look for companies with a solid track record.
Right. Consistent payments, a strong financial history.
Exactly.
And a good business model.
Absolutely.
So it seems like the dividend yield's really helpful.
It is.
But it shouldn't be the only thing that we consider.
Absolutely not.
We still have to look at their financials, their growth prospects.
Absolutely. You want to make sure those dividends are sustainable.
Okay. Is there anything else?
Yeah, the book also introduces a a kind of lesser known but potentially very valuable tool called the growth formula.
The growth formula.
The growth formula.
Okay, this is intriguing. What's the thinking behind it?
Basically, it's an extension of the PE ratio.
Okay.
But it factors in the company's expected growth rate.
So it's recognizing that businesses change.
Absolutely.
And it takes that into account.
Exactly. And the formula itself was developed by Benjamin Graham, who's considered the father of value investing.
Oh, all right. So it combined the earnings per share and the projected growth rate.
Exactly.
To arrive at an estimate of what the company's worth.
Exactly.
Okay.
Yeah.
But how do we determine that growth rate?
Well, it's a combination of looking at historical data, looking at industry trends, and then using your own judgment.
So it's a bit of art, a bit of science.
It is. And once you've calculated that intrinsic value, you compare it to the current market price. And if the intrinsic value is much higher, that might be a sign that the stock is undervalued.
So we're looking for those hidden gems.
Exactly.
Whose true worth is not reflected in the current market price.
Exactly. And while no valuation method is perfect, the growth formula at least gives you a way to factor in that growth potential.
I like that. These valuation tools that you've shared are really insightful. They're kind of like unlocking those mysteries of the market.
Absolutely.
All right. So let's move on to portfolio management, which is putting together a collection of investments that are aligned with your goals and your risk tolerance.
Exactly.
Now, we briefly touched upon diversification and patience.
Right.
How do we actually go about constructing a well-balanced portfolio?
Well, one of the things the book stresses is to think of your portfolio as a collection of businesses, not just a collection of stocks. You want to own a piece of good businesses.
Right. So companies with good management, a strong competitive advantage.
Exactly. And, it has to be aligned with your risk tolerance. How much are you comfortable losing? How long are you planning to invest for?
Right. So those answers will determine how I allocate those assets.
Absolutely. And it's about tailoring your portfolio to your individual circumstances.
Okay. Right. Now, speaking of allocation, the book recommends setting target percentages for different asset classes.
Which does.
Right? Like stocks, bonds, real estate, commodities. How do we go about setting those targets?
Well, there are a lot of different approaches.
Okay.
But one common guideline is to take your age, subtract it from 100.
Okay.
And that's the percentage you should have in stocks.
Oh.
So if you're 30 years old, you'd have 70% in stocks.
Okay.
And 30% in things like bonds.
I like that rule of thumb. But even if we do have a well-defined strategy, the markets are very volatile, right? So how do we handle those fluctuations? How do we avoid making rash decisions?
The book emphasizes discipline, sticking to your plan. It's natural to feel anxious when the market is going down or euphoric when it's going up.
Right.
But you have to detach from those emotions and remember that the market is cyclical.
So it's about reminding yourself of those long-term goals and avoiding those, emotional reactions.
Absolutely.
Like the panic selling or chasing, the latest hot stock.
Right. And the book also stresses the importance of reviewing your portfolio periodically.
Right. So it's not a set it and forget it.
It's not. You have to stay engaged, see how things are performing, and make adjustments.
So what are those key triggers then that might prompt us to buy or sell a stock?
Well, the book advises against following the herd. Don't just buy what everyone else is buying. You have to do your own research. Look at the company's fundamentals. How are they performing? Do they have a good management team?
So we're not just buying a piece of paper. We're buying ownership in the company.
Absolutely. And you have to make sure it's a good company. And, the book does outline some scenarios where selling might make sense.
Okay.
So, if the company's fundamentals have deteriorated, if the stock has become overvalued, those might be reasons to sell.
So it's okay to let go.
It is.
2. Welcome back to our exploration of 7 secrets to investing like Warren Buffett. In our previous segment, we talked about quite a bit, from financial habits to financial statements.
We also covered economic moats as well. Right,
and those competitive advantages that protect a company's profitability in the long term. And I'm really interested to delve into this art and science of valuation to figure out if a stock is a true bargain.
Let's jump right back in and explore that growth formula we were talking about.
Oh, the growth formula.
Yes.
It was fascinating to me because it seemed to take that traditional PE ratio a step further, incorporating the growth rate.
It does. It takes into consideration that companies are, always evolving,
Right.
Ideally growing their earnings.
So we're not just focused on their current earnings, but
Right.
What we think they're going to earn in the future.
Exactly. And this specific formula was developed by Benjamin Graham, the father of value investing.
Okay.
And he combined the earnings per share with the anticipated growth rate to come up with an estimate of its intrinsic value.
So it's almost like looking into a crystal ball and looking into a company's future.
It's recognizing that a company's current earnings might not tell the whole story.
Okay.
Especially if it's in a rapidly growing industry.
Right.
Or if they're about to introduce a revolutionary product.
Can you walk me through like the mechanics of it? How do we apply it to the real world?
Sure. Let's say we're looking at a company, their earnings per share are $2.
Okay.
We think they're going to grow, let's say 10% per year for the next 10 years. We plug those numbers into the formula and it gives us an estimate of what that company might be worth.
But how do we determine that growth rate? That seems a little, subjective.
It does involve some judgment, some analysis.
Okay.
The book suggests starting with the company's historical growth rate.
Okay.
Over the past 5 to 10 years.
Okay.
And then adjust that based on, what you think the industry is going to do, how competitive the landscape is, how good the management team is.
So it's a bit of art and a bit of science.
It is. And then once you've got that intrinsic value, you compare it to the current market price.
Right.
And if the intrinsic value is much higher, that could be a sign that the stock is undervalued.
So we're looking for companies that have more potential.
We're looking for those bargains
Right.
that the market hasn't recognized yet.
And although this growth formula isn't foolproof, it gives us a good starting point.
It does. It gives us a way to factor in that growth potential.
These valuation tools are really, really fascinating.
They are powerful tools.
All right, so let's switch gears a little bit.
Okay.
And talk about portfolio management. That's putting together a basket of investments that meet our goals and our risk tolerance.
A crucial part of investing.
And we briefly touched upon diversification and patience.
We did.
How do we create a well-balanced portfolio?
Well, one of the first things the book says is to think of your portfolio as a collection of businesses.
Okay.
Not just a collection of stocks.
Oh, I see.
You want to own a piece of good businesses.
So companies with good management, strong competitive advantage, potential for growth.
Absolutely. And you have to align it with your risk tolerance.
Okay.
How much are you comfortable losing? How long are you planning to invest?
Right. So those answers will determine how I allocate my money.
Absolutely. It's about making it personal to your situation.
Now, speaking of allocation, the book suggests setting target percentages for different asset classes.
It does. Stocks, bonds, real estate, commodities, things like that.
Right. How do we go about setting those targets?
Well, there are lots of different approaches.
Okay.
But one common rule of thumb is to take your age, subtract it from 100.
Okay.
And that's the percentage you should have in stocks.
Yep.
So if you're 30, you'd have 70% in stocks.
Right.
30% in bonds.
I like that rule of thumb. But even if we do have a good strategy, markets are volatile.
They are.
So how do we manage those fluctuations?
The key is discipline.
Okay.
You have to stick to your plan.
Right.
It's natural to feel anxious when the market's going down or excited when it's going up.
Right.
But you got to detach yourself from those emotions. Remember, the market's cyclical.
So it's about reminding myself of those long-term goals.
Absolutely.
And avoiding those emotional reactions.
Absolutely. Don't panic sell just because the market's down. Don't chase the hot stock just because it's up.
Right.
And it's important to review your portfolio periodically.
So it's not just set it and forget it.
It's not.
So what triggers should we be looking at to buy or sell a stock?
Don't follow the herd. Don't buy what everyone else is buying. Do your own research. Look at the fundamentals. Is the company performing well? Do they have good management?
So we're not buying a piece of paper.
We're buying a business.
We're buying ownership.
Absolutely.
Okay.
And there are times when selling makes sense.
Okay.
If the fundamentals have gone down, if the stock has become overvalued, those might be times to sell.
So it's okay to let go.
It is. You have to manage your portfolio. If the story's changed, it might be time to move on.
But even with all this, there's still a big psychological component to investing. How do we manage that? How do we stay rational?
Well, The book has a whole chapter on developing the right mindset for investing. It talks about patience, independent thinking, discipline, learning from your mistakes.
So emotional intelligence is really important.
It is. It is. The book says success in investing is more about temperament than IQ. You have to be able to weather the storms, stick to your plan, be willing to learn.
So having that strength to not make rash decisions.
Absolutely. And be willing to admit when you're wrong. Analyze your mistakes.
Oh, okay.
Learn from them.
So it's okay to make mistakes as long as we learn.
It is. No one gets it right all the time.
Right.
It's about self-reflection, adapting, and always learning.
We've covered a lot of ground in this segment. We talked about the growth formula, portfolio management, risk tolerance, and now this mindset.
It's been a great overview.
And in the next segment, we're going to wrap everything up with a 10-point summary.
We are.
And some thought-provoking questions to help guide our listeners on their journey.
I'm looking forward to it.
And welcome back to the final part of our deep dive into 7 secrets to investing like Warren Buffett. So we've really explored a wide range of financial concepts. We talked about the importance of building those solid financial habits. We even learned how to decipher those sometimes intimidating financial statements, and we explored several valuation techniques.
We did, and we even talked about those portfolio management strategies and how important it is to develop the right mindset for successful long-term investing.
It's been quite enlightening. I feel much more equipped to approach the market with more confidence. I have a much deeper understanding now of the core principles that have guided Warren Buffett, through his amazing journey.
And now to bring it all together and give you some actionable takeaways, we're going to summarize the book into a concise 10-point action plan. Think of it as your guide to building wealth, the Warren Buffett way.
Oh, a 10-point summary.
Yes.
That's fantastic. So like a condensed version of Warren Buffett's wisdom.
Absolutely.
Okay, let's get started.
Okay, number 1, pay yourself first.
Okay.
This is Buffett's golden rule.
Right.
You should be setting aside at least 10% of your income for savings before you pay any bills or buy anything.
So we're prioritizing our future self.
We are.
Okay, that's a good one. What's number 2?
Number 2 is building that rainy day fund.
Okay.
You should have at least 3 months worth of living expenses in an account that you can access quickly. This will protect you if something unexpected happens.
Right, that financial safety net that we spoke about.
Exactly.
Okay, number 3.
Number 3 is make sure you have enough insurance.
Okay.
Medical, disability, life insurance, all of these can protect you from big financial setbacks.
So acknowledging those risks and mitigating them.
Exactly.
Okay.
Number 4 is to pay down high interest debt.
Okay.
Especially credit card debt. Those interest rates can really hurt you.
Yeah, getting rid of those financial burdens.
Absolutely.
Okay, number 5.
Number 5 is start investing early and let compounding work its magic.
The 8th wonder of the world.
It is. It is.
Okay.
Number 6.
Number 6, invest in businesses that you understand.
The circle of competence.
Exactly. Stick to your areas of expertise where you can make informed decisions.
Right.
Number 7, look for companies with durable competitive advantages.
Those economic moats.
Exactly. You want companies that can protect their profits and market share.
Right. So whether that's a strong brand, a unique product, or even legal barriers to entry.
Those are all important factors.
Okay.
Number 8, analyze those financial statements.
Okay.
Look at the balance sheet, the income statement, and the cash flow statement to assess the company's financial health.
We want to understand the story that those numbers are telling us.
Absolutely.
Okay. Number 9.
Number 9, master the art of valuation.
Use those different techniques we talked about, like net, price to book, PE ratio, to determine if a stock is truly undervalued.
Become that financial detective.
Exactly.
Okay, and lastly, number 10.
Number 10, be patient and stay disciplined.
Okay.
Remember, investing is a marathon, not a sprint.
Right.
Stick to your plan. Don't get emotional. Let time and compounding do the work.
So those 10 points offer an amazing roadmap for new investors, and they really capture the essence of Warren Buffett's approach to investing.
Absolutely. And I'd like to leave you with a final thought. What if we applied these principles of value investing not only to our financial lives, but also to other areas of our lives?
Oh, okay.
Like our careers, our relationships, our personal growth.
It's like we're we're choosing to invest our time and energy.
Exactly.
Right.
What if we sought out those opportunities that offer the most potential for growth and fulfillment?
And maintain that same long-term perspective and discipline. It's a beautiful analogy, and it reminds us that the principles that guide successful investing can really apply to any aspect of our lives.
We hope you've enjoyed this deep dive into 7 secrets to investing like Warren Buffett. Remember, investing is a journey, and continuous learning is a big part of that. Keep exploring, keep asking questions, and approach the market and life in general with curiosity and a long-term vision. Thank you for joining us.
Thanks for listening.